Robbo, welcome, mate,
to
Quant Cartel. Mate, very, very casual chat, obviously, but I wanted to get you on because for those that don't know, I've known Robbo since year one. I think my oldest mate. So yeah, we go back a way. Very, very happy for how he's matured from a young lad into someone who's now CEO of a very successful investment firm, management firm, great family life, etc. So congrats, Robbo, and yeah, and thanks for coming on, buddy.
Happy to be here. Thanks for having me.
Yeah, no worries. So I thought we've actually got a good little group, given your current job in the room. So I know Lockie's at Morgan's, Chris manages money. Yeah, so I think it'll be a really good chat with you today. But do you just want to give us a quick overview of your background and who you work for now and what you do day to day?
Sure. So I've spent the last 20 odd years mostly working for larger institutions. My last role prior to Alvia Asset Partners was at UBS on the investment management side of their business. I live in Brisbane, but was working out of Sydney mostly. Most of my clients were down in Sydney and Melbourne, looking after private banks and family offices and some of the largest sort of wealth management groups in the country. Had enough of the FIFO work and the large sort of corporate institutional world. And I'd known a bloke called Josh Derrington for some years, predating Alvia. He set up an investment management business at a multifamily office back in 2016, after also having worked in large corporates, institutional funds management businesses. And that was really his opportunity to set up an investment management business that would invest how a private investor would invest. And really this idea of unconstrained, removing sort of the arbitrary restrictions, whether it be geographical restrictions. So in listed markets, not just obviously looking at the Aussie market, but if we can find a great business that happens to be listed elsewhere and it's trading on a far cheaper valuation than a similar business that has similar attributes listed in Australia, then why wouldn't you buy it if you're thinking of your own personal wealth? In the institutional world, it's very difficult to do that. If you're running an Aussie equities portfolio, then obviously you're not going to go and buy stuff that's listed, in the UK. So he had an opportunity to build out this unconstrained model within a multifamily office back in 2016, and that particular business did a whole range of things, including accounting and bookkeeping and property management for successful families. But Josh ran the investment management component of that business. And that's when I met Josh. And then fast forward to 2020, the investment team of that business did a management buyout to lift out and form Alvia. So Alvia doesn't do family office services. We don't do the accounting and bookkeeping piece. We purely do the investment management piece for some of the wealthiest families in the country. And but still using the same principles of, one, preserving capital, and two, targeting absolute returns, ignoring index returns, operating across multiple asset classes, multiple geographies, in both public and private markets. And that was really a critical extension of the philosophy of, well, if I want to have this idea that philosophically, if I want to buy great businesses and I don't care where they're listed, you take that same philosophy one step further and say, well, if I can find a fantastic private business, a private operating business that I can make a great return from and has significant barriers to entry and competitive advantages and an economic moat, just like a listed company would, then why wouldn't we consider it? And typically the families we represent are very used to that style of investing, given most of them have made their wealth through running some sort of operating business. We typically step in when they've had a liquidity event from that business. Not always. Sometimes it's a business that's been around for decades or generations in some cases, and it's spitting off enough cash that they've got substantial capital outside of that now that they want managed. And we take direct stakes in those private operating businesses as well. So they're sort of the two parts to our business. We've got the public market side, which is still very different to the type of work that you do, Marto. Obviously, the holding periods are a bit different. We tend to have an average hold of sort of 5 years, would be pretty typical. So ultimately, we're looking at businesses where we want to be able to project forward the EPS growth, and that will be a pretty strong correlation between the share price over, say, 3, 4, 5 years. But as we've just seen this morning, that has almost nothing to do with what a company's share price will do over a short period of time, 6 months or minutes or days. It's really driven by sentiment and a whole bunch of those data points that you've got in that spreadsheet there, which is really driven by human emotions and investor psychology. You're able to track behavioral patterns because humans tend to do similar things when they're put in similar situations. So, but ultimately, we believe that a fundamentally strong company of high quality that can grow its earnings will have a higher share price in 5 years' time. And if we can forecast those earnings, then we've got a pretty good idea at being able to forecast the share price over long periods of time. It doesn't work over short periods of time, which is why our hold periods tend to be higher. But we're constantly challenging ourselves as well, because you can have a view and you can form a confirmation bias, and it's knowing when your thesis hasn't stacked up and you've made a mistake in your analysis, and being able to pull the pin pretty quickly. So just because we're long-term buy and hold, it's constantly challenging that assumption that we're good analysts and able to find great companies. And it's like, well, what are we missing? So that's our business. We manage about 650 million now for about 50 or 60 families. Business has grown really strongly. I came on board from UBS in early 2023. Josh is the CIO. He leads the investment team. I'm obviously the CEO. And since sort of early 23, we've grown about double. So we've probably gone from about 300 to sort of 650 now. So the business is growing really strongly, and headquartered in Brisbane, small office down in Sydney as well that we set up late 2023. That's kind of the sort of 5-minute overview of my background and our business.
Oh, well, you want to tell Rob about your father-in-law, mate? Or father?
Oh, yeah. Graham Watman?
Oh, Graham Watman?
Yep.
Yeah. Seriously?
That's my yeah.
He literally tried calling me about 10 minutes ago, and I sent him a text and said, "Sorry, I'm in a meeting. I'll call you back." Really?
Yeah. Do you want to explain that one, Nathan? You'll probably do a better job than me.
Oh, wow. So he's your father-in-law?
Yep.
Okay. Graham's a lovely guy.
He is. Good bloke.
Yeah, we well, for the others, Graham he's a bit of a veteran of the industry. He's run a very successful accounting business / essentially multifamily office down in Sydney for very many years, and we have a number of mutual clients. We actually bought a wealth management business off him. He was one of the shareholders down there, which helped us set up a Sydney footprint. So yeah, I speak to Graham a lot. He's got some really interesting clients, a lot of European sort of multi-generational families that he looks after, particularly out of Germany. One of our larger clients was over from Dusseldorf with Graham over Christmas, or just prior to Christmas, and Graham flew into Brisbane with this particular client. I think he ended up spending about 5 weeks with him.
Yeah, we spent a lot of time together. Good bloke.
Yeah. Well, there you go. Wow. Okay.
Oh, well, eh?
There you go. Yeah.
Incredible.
So, Bo, are you married to his
My
daughter?
mother's married to Graham. Yeah.
Oh, really?
Yeah.
Oh, okay, there you go.
Small world, mate. Small
Very
world.
small. Yeah.
Right.
And Robbo, what controversial or different kind of perspective do you reckon you guys have versus a lot of the other investment managers out there, do you think?
What controversial?
Or unique perspective?
Yeah, look, unique. I don't think this will be particularly unique. I think everyone will say they've got it, but I would say one of our particular edges is our temperament, patient temperament. And that really comes from Josh. He's a very well-considered person, but he's one that sits around a room with our analysts and portfolio managers and won't necessarily say a word. You can tell he's thinking a lot of things, and he'll have a very slow and considered response. So I think having that patient temperament does stand out when we're all prone to emotion and making decisions on the fly, or because we've spent 50 hours writing up full financial models on a particular company or an 80-page long-form analysis. You're much more inclined to fall in love with something that you've spent a lot of time on. So it's constantly challenging that. I think the other thing that makes us unique is that we have to invest in everything that we put client capital into, whether it's a listed company or a private operating business or an office tower, whatever it may be. So we have our own balance sheet that invests, and also the staff, particularly Josh, given his background. He's exited a few businesses now two to private equity, one to a Canadian pension fund. So he's obviously done well building up a substantial pool of capital himself as one of our clients, as well as the CIO and founder of the business. So that alignment piece, if you're talking, it's certainly not controversial, but it's very difficult to have that similar level of alignment with your clients in a corporate institutional model, where obviously doesn't mean that there's not good investment managers and good investment advisors in those large institutions. They just don't have the same alignment structure as someone that's investing in the same opportunities, paying the same fees, same legal structure invested alongside. And I think the last bit I would point as a differentiator would be the agnosticism. So our background is primarily equities. We've got one of our PMs is out of Hyperion, which is a successful Brisbane-based global and Australian equity investment management business. We've got people from Goldman's and Merrill Lynch and Dalton Nickel Reed, which is, that's where Josh worked at one stage in the Australian equity space. But so although we have a expertise in the equity side, it's recognizing that, fundamentally there's points in the market where a certain asset class is out of favor. So no matter how good you are at bottom-up fundamental research, if Australian businesses, listed companies aren't looking attractive, then having the flexibility to go elsewhere, whether it's offshore or it could even be to other asset classes, holding gold bullion or US treasuries or whatever it may be. So that multi-asset class approach works well for us on the mandates that we run.
And just quickly, mate, what's the kind of rough breakup?
About 70% of our business would be what we call mandates, which is essentially public market multi-asset portfolios managed in-house by the analysts and portfolio managers, primarily made up of direct securities. And the other 30-odd% would be private markets. The private market side of the business is the fastest growing part of our business. The challenge is obviously deal flow. We do one or two on average a year. We're in the middle of one now that will settle in March, a private operating business. But the last deal we did in that space was December 2023. So unlike the typical private equity model where you go out and raise capital and then find the businesses to buy, so you raise a fund, obviously, and you might have particular attributes that your investors opt into, and they've backed you to find great businesses. There is that inherent pressure when you've got capital commitments to find an opportunity to buy. We don't have that model. So we have our own custodial license, but we'll find the deal first. And then we know it's essentially underwritten by the capital that we represent, and then we'll go and raise after we've found the opportunity. So there's no pressure to lower standards at all, or go outside our areas of expertise to go and chase a deal.
Interesting. Chris, do you want to jump in with anything, mate?
Chris, I think your mic's muted there. There we go.
No, but what I will say, that's fucking impressive.
Oh, thanks, Chris. It's kind of you.
Having been in the industry for 35 years, it's a pretty good segue into a nice business you've jumped into, and being out of Brisbane. Wow, you've done very well, very, very well. Congratulations to everyone in your team.
It's very, very kind. Little old Brisbane's done a bit of growing up, I reckon, in the last 5 or 10 years. I've lived here my life, but mostly for the last 16 years worked out of Sydney, and I never would have thought that I'd be able to find something close to home and that really sort of tick the boxes. But having known investment management businesses around the country and around the world with a lot of the travel I did previously, there's not too many that that have this same approach. And look, it's not credit to me, it's credit to Josh and the team that he built. And the way these guys invest, they're very good at what they do, but they're just good people too. There's no showboating. They're naturally, in fact, it's actually the opposite. I'm constantly, naturally, Josh is a very private individual, and the team have flown under the radar. And but I think there's plenty of ability to scale this business. It's just taking on the right type of clients. So it's been pushing the team out of their comfort zone and saying, I think we can build something bigger within reason. It's not growth for growth's sake, but credit to the guys sitting outside there at the moment. What's your background, Chris? Are you at Morgans? Is that what Marno said?
No. I've had a career
Lockie at Morgan, but Chris, you manage money, don't you, at the moment? Or?
Yeah, I do. Yeah, I do. My background was I started in the futures market and derivatives back in 1989.
Right.
And then had a career in Macquarie Bank, and left in the GFC, then started my own wealth management and accounting practice. Recently sold out of my accounting practice, sold the retail book of all the wealth.
Yeah.
And now I just manage a small group of high net worth with a very similar process in that I don't advise anyone that I haven't got my own money in on the asset myself. So when you said that, I was going, seems like I'm on the right track. But it's certainly I'm much smaller, and I'm probably, to be honest, I'm quite selective as to who I want to work with. My time.
Yeah.
So I'm not looking to go and build another big business. Definitely not.
Mm. Well, mate, you would have seen it all if you started in '89. You've been through a couple of cycles, and
yeah, definitely.
Coming out of Macquarie, there's there'd be a few stories there, I'm sure. So do you have your own license through your wealth management business?
Yeah.
Right. So
got that in 2009.
Okay. Oh, wow. Right. Long time.
Yeah, I've had it for a long time. We had a dealer group. There's 23 advisors there. We're very much a tech-driven solution with some amazing AI technology. We're well ahead of the curve. And that's going great guns. And I met Mardo, and I've only really just got back into trading in the last 6 months.
Right.
Because I sold a practice, give me a little bit of time back, and I've pretty much forgotten how to trade and have to start again. It's certainly not like riding a bike.
Right.
You do forget. you do forget your rules and stuff like that.
Well, I imagine that just particularly with AI tools and the level of data available out there, it's probably a bit different to what it was, say, 10, 15 years ago. It's almost too much data, wouldn't it be? It's trying to synthesize down to something, manageable.
I looked at it, such a big game changer when ChatGPT came out for us. We were hard coding. I can do a bit of coding. I'm not very good at it. I hate it. But when ChatGPT came out, that was a real game changer on how you can manage data and what you can get out of it. Mardo's already on that program. We're probably taking it to a completely different level in our financial services licensee and tech solution called iComply 2. But being able, really, the play on that now is not so much being able to code; it's being able to be a prompt engineer, and how you silo databases and then prompt within those databases, which are really just what a prompt engineer is, just a plain English if statements. It's really all it is. If this is the result, then go and do this, rather than writing a formula, which always breaks as a code anyway. So I've learned a lot in the last couple of years. But like I said, it's not about me; it's about you. And I think it was very, very impressive where you're at and your partners there. And again, I just say congratulations.
Thanks, Chris. I know this is not about you, but I'm curious. What was the decision, the catalyst for selling the accounting side of the business?
Probably just more personal than anything else. Probably just, in my early 50s. Probably the kids who left the house. We relocated the main home from East Sydney to up on Lake Macquarie.
Right.
So it's really more a lifestyle position, but I'm still working. Working just as hard as I was before. So it hasn't changed at all. And
Robbo, how's the Trump dynamic? Has that changed? I know you got the longer time horizon, but has that affected your thinking in any way in terms of listed equities or anything else?
Good question.
It has, although I would say our thinking has been similar for probably 12 months now. So we've been more likely sellers of US equities than buyers for some time. We do own some US listed businesses, but mostly the opportunity has been European and UK markets. A little bit early.
Oh, the UK is firing, mate, isn't it?
Yeah. Mate, it's just, I think the whole Trump thing, it's for us, the biggest challenge, we're fundamental investors, which means, it's bottom up looking at businesses, but the world is the level of capital flows that are flowing around. You cannot ignore the macro piece. And as much as we can analyze a company and look at the management team and are they incentivized, for shareholder growth over the next 5 years, and those things are certainly important. Just the level of capital flows around the world is making shorter term macro decisions more a part of our process, which can be frustrating. So, if you look at the US at the moment, I think, inflation seems to be relatively under control, but there is still this bifurcation that has been caused by sort of lower income and the ultra wealthy. So that is driving investment trends. Trump's policies on face value are certainly inflationary. Whether he'll implement everything he said, I think the answer is probably not. His track record is that he typically won't do everything he said, and partly I think there could be sometimes there's a bit of bluffing going on there, which is quite effective anyway at getting the outcome he wants without actually implementing the policy. We're concerned about US debt levels. They're now at 125% of GDP, something like 35 trillion. They got 5 trillion of debt rolling off this year, and their interest bill alone is concerning. Now, as long as they can keep printing money, then it's okay. But your purchasing power is getting knocked. If you just the money supply in the US is just astronomical. So it's the market. It's not surprising that it's run like it has. The US market's up sort of 100% over the last, since COVID, really up 20% I think the last 12 months. So certainly been the place to invest, for a long time. This idea of US exceptionalism, that term that's been floated around in the last sort of 6 months. I don't think it's going anywhere in the short term, but broadly speaking, we are concerned with valuations, particularly in the mega cap end of US equity markets. And given our first principle is preserve capital, the families we represent don't need to be taking excessive risk. They're typically step one, don't lose what I've got, and then I want to patiently compound from here. And if they can compound in public markets sort of 10 to 15%, that's more than enough for these families. And then private markets, obviously returns need to be higher to justify the illiquidity. So you're talking more sort of your 20, 25% type IRRs for those types of businesses, but they don't need to be taking that risk. And at the moment, there's a lot of risk in the system. So we're more defensively positioned broadly. I'd say we're holding more fixed income at the moment than we were, say, certainly a few years ago when yields were at zero. And we've just recently put on our first short for a long time, actually, on the Nasdaq. Now that's a short-term position. We use that more as it's a ballast in the portfolio, but it's an opportunity if markets do have some sort of dislocation event. It's the point where we want to be really quick to react and reweight portfolios back into equities. And the guys did it really effectively sort of early 2020, that whole March, April period. We really rebalanced portfolios into equities when everyone thought the world was ending. And clients did really well out of it. So it's having a bit of defense in the portfolio that we can use as a rebalancing tool when and if markets have that dislocation, which we'd think is a reasonable chance of happening.
And sorry to cut you off there, Nath, just out of curiosity, are you assessing that based on the same fundamental factors that you'd assess an individual company? Are you looking for the market's overall price to earnings and growth?
Yes, there is an element of that. It wouldn't be to the same degree, though, that the fundamental analysis happens bottom up. And look, this is part of it. Like, investing is not there. Obviously, there's a whole quantitative process, and we have quantitative screens that distill the universe down into a manageable number of companies to assess. But that's probably about 60%. We have this thing called the Business Investment Opportunity Score, BIOS, which is a proprietary scoring system we use for all listed companies. And that's 60% weighted to those quant measures, mostly around quality and valuation factors. But then the other 40% is qualitative. We've got this question bank of 250 odd questions that randomly generates 50 that get sent out to the team, and they have to answer them independently, each of the investment analysts, portfolio managers, and as well as the CIO, to try and challenge those human biases. And a lot of those can be macro driven as well. The chair of our investment committee is a guy called Jim Christensen, who used to be the CIO at QIC. And before that, he was the CIO at Telstra Super. His background is much more macro driven. So he brings a lot of rigor from a macroeconomic asset allocation perspective in the investment committee meetings. I don't know if that answered your question, Bo, but yeah, there is assessments there.
Mm-hmm. Do you ever look at things like skew index or risk of big events like that?
There is elements of that. Like the VIX index is a huge one that the guys are looking at, volatility in markets. That's driven that, elevations in the VIX index recently have driven a lot of the decision behind putting on that short for the NASDAQ. But yeah, there's a whole range of different factors, but it's not purely quant driven in that the idea generation purely comes from some sort of quantitative analysis. It could be idea generation from the team reading something about, I don't know, something in a European equity manager that's more obscure is doing something overseas, and the guys find an interesting investment idea, and then it's digging down the rabbit hole to figure out, is that actually investable and does it stack up? And but also knowing when you're going too far down a rabbit hole and wasting your time, being able to sort of pull it back pretty quickly, that's important too.
Oh, Marto, I think you're muted there.
Yeah. Lockie's with Morgans. up in Armidale. He might be, I don't know if he's got his mic on, but any comments or anything for Wowo, Lockie, from your standpoint?
Nathan, I'm curious about your view on the US in terms of their debt issues. Have you guys looked out long term as to, every civilization has crashed their currency at some point, and these guys are looking at, hitting on a big scale, looking the same way. How do they get out of this debt hole they've got into?
Yeah, it's a challenge, because the opposite to that would be, well, the US dollar is the reserve currency of the world, and but there are others now, like gold has had a fantastic rally over the last 12 months, and that's an ultimate reserve of currency. And then you have cryptocurrency as well. So Bitcoin is increasingly, we're certainly not. I think it's fair to say we're not believers in Bitcoin. We're certainly believers in blockchain technology, but Bitcoin is not something that we would invest in. But there are plenty of others, including institutional investors now, that are seeing that as a store of value. How does the US get out of their debt problem? Well, they can try and inflate their way out of it, which is essentially what Trump's trying to do. But there is a tipping point. At 125% of GDP, debt to GDP, that was sitting about 100% of GDP only 4 years ago. It's a huge level of debt they've taken on in the last 4 years. It really started ramping up in the GFC sort of 2008, but in hindsight, that was nothing compared to what we've seen now. But then you look at Japan. I think Japan's running at sort of 200 or 250% of debt to GDP. So people go, well, geez, maybe the US can go for a lot longer. How long can they put this off? Is it 5 years? Is it 50 years? I think their current deficit is sitting at sort of 7% of GDP. That's all-time highs. Whether there's some cataclysmic event, I think all great nations, ultimately civilizations fall. We saw it with the Roman Empire and the British Empire. And, does the US dominate the world for the next 1,000 years? Chances are definitely not. But could it be another 150 years? And maybe, who knows?
Yeah, it was just interesting. I was reading some good analysis here just this last week, talking about with these, with all the with the suggestion of tariffs. And given half of my family's Canadian, so they were doing backflips over the weekend when that was announced.
Yes. Yeah.
They were trying to access markets and think, what the hell is going to happen here? And we were trying to give them. I was trying to say to them, well, maybe look at it from the other perspective, change the lens at which you look through this. And part of that was that some analysis came out to say effectively that, what they're, and this makes sense in a way, the US is trying to, manipulate the issuance of their currency. So at the end of the day, they can lower the interest rate on the 10-year bonds. Which, in other words, they're going to try and manipulate. They will manipulate, I suspect. And that probably keeps things stable, really.
Yeah. For a time. I think the hardest part is that it is very difficult to predict with someone like Trump in power. Like you use the tariffs, for example. He's a businessman, and he's obviously, regardless of what you think of him, he's a good negotiator. But you don't know where the negotiation tactics end and actual policy implementation happens. So, for example, who knows that his claim on implementing those tariffs on Canada, was he actually planning on doing it? And can Trudeau risk it calling his bluff? Well, the answer is no. They've had to come to the party pretty quickly, and now there's a 30-day pause on the implementation of those tariffs. And maybe Trump's achieved what he wants to have achieved simply by saying it, not having to actually implement anything. I think that the tariffs with China are an interesting one, because there's certain parts of the market that just, by putting a tax on imports, like you're not going to go and, are you really going to go and make T-shirts out of America? Like, that's going to, really hit that sort of lower socioeconomic end where, if they're not paying $10 for a Walmart t-shirt, they're suddenly paying $50 for a US manufactured t-shirt. But at the higher end, is it, chips and like onboarding sort of high-end technology manufacturing processes that from a federal security perspective are critically important, where you are willing to make companies pay over, and maybe the end consumer ends up paying for it, but there is a national security component to it. So being very selective by having wide ranging stances of, I'm just going to put a tariff on any imports, it doesn't, I don't believe that would actually, he would ever do that. But saying he does it maybe achieves his goals. It's the unpredictability. It makes it very difficult to invest behind.
Which is simply the reason for your short, I would imagine.
Yes.
It seems like a lot of his approach is sort of manufacture your way into prosperity. In a world where factories and machinery are going to be more automated, AI driven, do you think that approach is going to ultimately fail?
No, it could go the opposite, right? Because the biggest thing stopping US manufacturing is the cost of labor. And if you've got AI and robotics and those sorts of things that you're able to implement, where you can cut out 90% of the manufacturing workforce, maybe it does make it more viable to make some of this stuff in the US, or the same for Australia. But it does mean what happens to those jobs? That part of the workforce, those jobs will go. The counter argument to that is that humans are pretty innovative creatures, and we've seen it before with the invention of the Industrial Revolution, for example, and lots of people said, well, what about all the carriage makers? Where are they going to go? Well, we innovated our way into other parts of jobs that we don't even know exist yet. There'll be occupations through the invention of AI that in 20 years' time that our children will be doing that there's no university degree for nowadays.
Guys, I might just quickly run through a couple of things as we come up to 11 a.m. And then we'll grab any final questions of Robbo and wrap up. Just a quick comment. Obviously, the Aussie looks like it's going to close out in the green here, probably about 7 points up for the hour. So, probably suggesting that large falls are generally off the table here. We've obviously got those still pretty strong probabilities of heading lower, but if we break these highs, it's probably not something that I'd be really interested in holding. I just want to quickly show one thing before we move on. Let's share screen. Which is quite interesting. We got that gap down on the S&P this morning. Again, depending on which broker you're looking at, one was 3, one was 10 or something for me. But if we just filter a gap down and then a really large kind of first hour rally, it looks like we're going to close out 11 points higher, which is significant. It's kind of happened 3 times in the last 1,000 trading days, and we got 90 points to high, 117 points to high, and 144 points to high. So although that I'd suggest that may have something to do with why our market's holding up better than what I would expect, potentially a long trade on the S&P if you want to dabble in that market. So I'll leave that one. I'll leave that one there. But anyone got anything? Any parting comments for Robbo?
Yeah, Robbo.
Before we let him go.
What sectors are you watching at the moment?
What sectors are we watching? Well, on private markets, that's pretty easy to answer because we're pretty strong in healthcare. We love healthcare. Anything that's essential services, waste management. The deal we're about to do is in the food services space, so things that are fairly economically resilient. And it's similar in listed markets for us. You know, we love boring businesses that will turn up every day and, you know, have proven earnings and strong management teams. You know, so we're not huge investors in early stage tech. That's something that is just not in our area of expertise. Yeah, we love industrial businesses, sort of old world, relatively boring, and part of that's a function of the client base we represent. They tend to be, you know, families that have built their wealth through similar sorts of industries over long periods of time, and they're attracted to those types of investments, and they align with our sort of patient long-term philosophy.
Great.
Nice. All right, I think that's it. Thanks, guys. Thank you for coming on, Robbo.
No, thanks for having me, mate.
Yeah, we could talk for hours, no doubt, but be respectful of your time. But yeah, thanks, mate. I think there were a few little gems of insight in there, and I know you're not out flogging the name or anything like that, but the Alvia funds are open for investment.
Yep. Yeah, we've got, we do have a fund, the Alvia Family Office Fund, which is open to wholesale investors. That sort of sits on the side of the family office mandates that is the core part of our business. But yeah, happy to talk to anyone.
Is there a minimum investment for that one?
250,000 for the Alvia Family Office Fund. Yeah. Yeah. And
all right.
open to wholesale, no retail investors in that one. Yeah.
Mm-hmm.
But mate, thanks for having me. Yeah, congrats on what you're doing too, mate. It's you know, from when we're 5 years old running around your pool, burning our feet in the middle of summer, I think you know, life's taken us down some pretty interesting paths, and it's pretty cool what you're doing too. So well done.
Yeah, appreciate that, mate. I'll see you for another 40, mate, hopefully. So
yep.
But thanks everyone. Thanks for joining in. Sorry the Aussie doesn't seem to want to play ball today, but as I said, just keep an eye on the SPX overnight and through this session as well. So it might be worthwhile. Otherwise, have a good weekend, everyone.
Thanks, guys. See you later.
Everyone. Thanks, Robbo.
Thanks, guys. Robbo, do you just want to stay on for a sec, mate? And
yep. Sure.
Yeah.